So guys, there's many different types of mortgage protection plans. Now, when you're in the home, you guys want to first of all be yourself, and I truly mean that. When you be yourself, don't go and act like a sales guy. Don't go there and try to pitch them a product that they can't afford. First and foremost, understand they're a family that filled out a lead, which means that they need the help, right? They're all asking us to come in the home and go and see them and actually protect their family. For mortgage protection, what I do, guys, I focus primarily on the income of the home. Because if I can't pay my bills in the home, I can't afford my mortgage. If I can't afford my mortgage, the bank will foreclose on my home. It does not matter what I have in place, guys. It does not matter what they do, what they think may occur. It's about what's actually going to happen when they die. So first and foremost, you guys have to be very assumptive, which means assuming the sale. So you go in there, you're not going to go and think that they don't need the coverage. Because like Mika said prior, they're a family who are filling out these forms, right, who needs help. So what I would do, guys, is again, keep that in mind. I'm going to iterate. They're a family that needs help. So I'm assuming when I'm walking in that home, they're buying the policy no matter what. It's about can they qualify and will it meet their needs and their budget, which is basically the main point. You want to establish credibility and have a doctor-patient mindset. What I mean by that is, guys, when you go in there, again, we are the professional. It doesn't matter if you're a new agent, you've been here for one day. It doesn't matter, guys, you've been here for 5 years. We are the professionals. They don't know that. They fill the form out and send it back in. Once you go into the home, you're going to let them understand that, hey, I'm here to give you guys what you need. Now, I said something called goal and purpose, which we touched on later on today. But what that is, it sets the stage. It makes sure that you're meeting the proper expectations for that family. You're going to let them understand that, one, I'm going to put a product in place that's affordable. 2, we can see if you qualify. 3, I did the shop route for you guys. Which basically means that there's no way in hell I'm getting an objection in the home. And I mean that. I don't get objected in the home, guys. The only way I'm getting an objection is, wow, I really can't qualify? Like, there's nothing else outside of AIG 2-year period? That's okay. At the same time, it's going to protect equity in the home. Explain the process and make it simple. What I did now by saying equity rescue to a new agent, they're probably like, what does that mean? I'm going to touch on that momentarily, but keep in mind again, if they die, there's a huge balance that needs to be covered, which is a mortgage, right? If I don't pay that mortgage off, I don't have the monthly income to maintain that mortgage, I'm going to lose what I consider, what the family considers, one of their biggest assets. Because again, a mortgage is not an asset, it's a liability. Asset puts money into our pockets, liability takes money out of our pockets. So until they actually pay off that loan, they don't have an asset, and it's your job to go and protect that asset. Now, the last one, the most important parts as well, again, I said make it affordable. So there's 3 different points in a mortgage requirement that I hit. So I tell them that, guys, there's 3 different types of mortgage protection plans. There's option A, the full payoff. Option B, partial payoff. Option C, equity rescue. I'm going to touch on each subject, each of those topics today, and explain to you where I use that strategy. So the first thing, and first and foremost, full payoff. It's pretty simple, right? It covers the full mortgage. 100% of the people you sit with want the full mortgage covered. Now, do you know how many people I actually read a full mortgage on? Just throw out any number, guys.
10%.
0.
Yeah, exactly. Between 0 and 10%, literally, guys. Probably not even, I'd say, 1 in 100 people, guys. 1%, they don't need the full thing covered, because at the end of the day, they're paying down their loan. It's going to get less and less and less. If I go in there and I say, hey, Micah, you need $500,000 of coverage and that's it, I'm a sales guy at that point. I'm trying to push the product down their throat. I'm trying to make them feel like they need it, not tell them how much coverage they need. I want them to understand what happens. So when they ask for a full payoff, I'll only do a full payoff, guys, in the event where there's a primary income earner. Now that's going to be the major point where you're going to even look at a full payoff, which is in the event the husband or person passes away, there's nothing at all in place that's going to stop the house from being foreclosed. Nothing at all. And that's when you even look at a full payoff. The second, guys, and I mean, don't look at full payoffs because they don't need it. Secondary, I go to partial payoffs. Now that's going to be more geared to replace somebody's income to make sure in the event they become sick or disabled or unemployed for a short period of time, if they have a disability rider, that they're able to actually have enough income to maintain their home. Let's say, guys, they're 50-50 split in the home. Let's say Marisa and Christina, they're a household together, and all of a sudden Christina makes $5,000, Marisa makes $5,000. That's 10 together, right? Now, if one thing happens to them, their 10 goes down to 5. Now they just lost 50% of their income, but their expenses maintain exactly the same. They don't understand that, guys. People think that the bills are going to drop when they die. That's not what happens. Everything keeps on going. And their lifestyle is built on a 2-income household. So a very simple question would be, Bob or Christina would ask, how do you replace your income in the event Marisa passes away? And guys, be quiet. Let them answer that question. Seriously, you want to shut up and let them answer. They're going to talk, they're going to argue. They may say, oh, she'll sell the house, should be okay. And say, okay, tell me more about that. How is she going to do that? Do you handle the bills? Does she handle the bills? Who signed the paperwork? Who's actually going to control your estate? Do you have a trust? Do you have a will? You guys want to ask probing questions when you're doing a mortgage protection appointment, because the person who asks the most questions is truly going to win that appointment. And I mean that. The reason why I am a Hall of Fame producer and I write such a high clip is because when I'm taking the time with that family, I would just go through the options, guys. I sit there and I treat them like they're a family of mine. I act as if that was my dad, that was my mom. If they filled that form out, what I want somebody coming in that home and telling them. And you have to be very direct and confident. Because if you're not, guys, they're going to tell you, I don't need it. They're going to think, oh, I'm not interested, it's okay, it's too expensive for me. But you really want to make sure, guys, like Trey Huntington said, when he had that insurance broker come to his house and he didn't stick up for his family, he says, right? Like he didn't set up and grab the guy by his hair and say, hey, make my dad understand he needs this coverage. Same aspect in a mortgage, guys. They have a huge loan that they need to get covered. So there's no way you're leaving that house without them writing a policy. And you guys see failed them as an agent and as a person. Because if that was your family, you would not let them leave. All right, so really keep that in mind. The next point I'll talk about is what we call equity rescue, right? So the full payoff meant for young people who have a lot of money, or young people, low mortgage, or let's say they have a primary income earner where they have a lot of money that can take care of that home. Partial payoffs for income replacement, right? Sickness, disability. You may not even need to talk about the loan. You can just say, all right, if you guys end up getting sick today, what do you have in place that's going to pay your bills, right? What's going to come in place? Because they may have like 401ks, they may have retirement. That's for retirement at the same time. To keep that in mind. They're not at their employer telling them that, okay, this is going to pay off my mortgage when I die. No, it's designed for retirement. They want to make sure when they're 60 and 70, they can live the life they deserve. They all should be able to deserve that life. No one should have to liquidate their 401k, take away their grandchildren's college tuition just to pay for a mortgage, okay? That's not right. That's our job to kind of come in there. Another strategy I'll talk about, what I call equity rescue, is a pretty simple topic to understand. It's basically giving the family enough time to sell the home or refinance it, whatever they want to do. It's on their dime, not the bank's dime. So a very easy example, so I don't take too much time to explain equity rescue. It's in the event when the critical period of time, when the primary income earner or borrower passes away, the spouse or whoever's around has enough income to maintain the monthly mortgage payments between 6 months to 2 years. In that 6 month to 2 year period of time, the wife's going to be able to sell the estate, or the family can sell the estate. The client's going to be able to bury the family. The client's now going to tell the bank, hey, back off. They're not going to look at their coffee cup and think, how am I going to pay my bills? How am I going to handle my mortgage? How am I going to do all these things when someone dies, guys? Things hit the fan. We all understand what I mean by that, right? To be very transparent. People don't really think straight, right? I'm being very honest about that. How with my family? How with some of you guys as well? In that period of time, let's say the mortgage is $1,000, they want 1 year payments. I'm running a $12,000 8-year program. That's it. It's $12K whole life. To them, it's $12,000 of equity protection, which means in the event you pass away, you're going to receive 12 months of payments. In this 12 months of time, you're going to refi the home or sell the home. You make that choice, not the bank. In addition to that, there's more benefits that go with it. If they die of accident, for Eagle, it doubles, guys. In the event, they go 2 years down the line, it builds a cash value. It's better than the bank. $100, guys, times 12 is $1,200, right? 1,200 times 10 is $12,000. Times 20 is $24,000. Most families we sit with, we can put them into a policy for $100 a month of whole life, or even a CBO for universal life to qualify for more than $50,000. So in that 20 years, they would only have $24,000. Whereas on the other side, they're going to have either X amount of monthly mortgage coverage payments, or they're going to have an outstanding tax-free death benefit. Where is it smart to allocate that percent of income? To the $100 where in the bank it's only going to add up to, $1,200, $12,000 over 10 years, $24,000 over 20 years. Or in the place where if the next day the worst time happened, they're going to immediately have a much tax-free lump sum death benefit. It's an easy concept to understand, but the family, you have to actually sit there and explain it to them. Especially the CBO guys. In a mortgage, I'll be very honest, if they can qualify for that, there's no reason you do not leave the home without writing it. Because that same example goes back to the bank. In the bank, 100 times 12, I'm going to use an example because it's so much easier for me to do. It's 1,200, okay? Again, over 10 years, 12,000. 20 years, 24,000. On a cash back option, with someone, let's say, in the 40 years old, they're going to have between, let's say, $100,000 to $200,000. In the event they become sick, they can partially access that money. They pass away, their family gets between $100,000 and $200,000. What's more money, guys? Having potentially $24,000 over 20 years, or having $100,000 in 1 month, in 1 year, in 20 years. It doesn't matter when the time comes. They're always going to have that income to be able to pay for it. So to the family, it's not an extra expense because they already saved that money in the bank, guys. You're allocating income. You're telling them you don't put all your eggs in one basket. We're going to take 2 eggs, we're going to put it into a CBU 100. 2 eggs, put it into an IU for income retirement, or an IUL. A couple eggs into whole life to cover the bases. But remember, guys, that the family has to understand the concepts as well. Don't go in there and just say, hey, it's a money back program, you get all of it back, you can expect, to run the policy. Explain it to them. Explain where it's smarter to allocate the income. What it looks like, keeping $100 in the bank, what that true situation looks like, foreclosure, sickness, unemployment, not being able to work, reduction of income, compared to the other side where, yeah, sure, they maybe have in their mind an extra bill per se, but when the actual worst day does come, they have $100, $200, $300,000, guys, to actually live on. And that's what I do in the home. That's my main strategy, guys. Just focus on the family, make it affordable, make it easy for them to understand, and just hit those 3 points. Full payoff, partial, or equity rescue. That's all I got.